Could an adjustable rate mortgage be your ticket to a dream home or a nightmare waiting to happen? Hi, I'm Steve Jolly from Home Buying Skills, and I'm going to help you understand and when they're risky and when they can actually work in your favor. What's an adjustable rate mortgage or an ARM? An adjustable rate mortgage is a type of mortgage in which the interest rate applied on the outstanding balance varies throughout the life of the loan. With an ARM, the initial interest rate is typically set below the market rate on a comparable fixed rate loan, and it remains fixed for a predetermined number of years. After this initial period, the interest rate adjusts periodically, typically on an annual basis. These are the key features of an adjustable rate mortgage that you need to understand to protect yourself and your investment. The initial rate and period. The rate starts off lower than a fixed rate mortgage, and this initial rate is locked for a set period. You need to understand how long this is and plan for when it ends. The adjustment interval. After the initial period, the rate adjusts at regular intervals. Most of the time, ARMs adjust on an annual basis. The index. ARMs are tied to a benchmark interest rate or an index, like the LIBOR or the Treasury index, which influences the rate adjustments. As the index rises or falls, so does the interest rate you pay at every adjustment. Margin. This is a set percentage added to the index rate to determine the ARM's interest rate. Your interest rate will be calculated at every adjustment by adding the index with the margin. Interest rate caps. These limit how much the interest rate can increase during each adjustment period and over the life of the loan. These help protect you from dramatic shifts in the market. Now, if you have any questions, leave them in the comments below and I'll answer every one. What are the risks associated with ARMs? The risks associated with adjustable rate mortgages primarily stem from the variable nature of interest rates and the uncertainty this introduces for borrowers. And here are some of the key risks. Increasing interest rates. The most significant risk with the ARM is that interest rates will increase over time. And if the index rate to which the ARM is tied goes up, the interest rate on the mortgage will also rise, leading to higher monthly payments. And if the payment goes up dramatically, you'll face payment shock. And this can be shocking to borrowers who are not financially prepared for higher payments. ARMs are more complex than fixed rate mortgages, with terms that may be difficult for some borrowers to fully understand. This includes understanding indexes, margins, adjustment intervals, and caps. While rate caps are designed to limit how much interest rates can increase, they may not prevent payments from becoming unaffordable. Even with caps, the rates and payments can increase significantly over the life of the loan. Some borrowers plan to refinance their ARMs before the rate adjusts. However, refinancing is not guaranteed. It depends on the borrower's creditworthiness, equity in the home, and prevailing market conditions. If interest rates have risen broadly, refinancing may not be advantageous. And if the housing market declines, borrowers could end up borrowing more on their home than their home is worth, known as being underwater. This can make it difficult to sell or refinance a home, especially if the mortgage payments have increased due to rate adjustments. Some ARMs come with prepayment penalties that make it expensive to refinance or pay off the mortgage early. It's important for you to fully understand how your mortgage works, how much your payments could increase, and whether you can afford higher payments in the future. You should also consider their long-term plans, such as how long you intend to stay in the home. If you need a trusted agent anywhere in the country, click on the link in the comments. Here are some scenarios where choosing an ARM might be advantageous. If you plan to own the home for only a few years, you can benefit from the lower interest rates without worrying about future rate adjustments. If you anticipate that your income will increase significantly in the future, you may be more capable of handling potential increases in your mortgage payments when that rate adjusts. And in a market where interest rates are expected to decline over time, an ARM could save you money as the rate adjustments could lead to lower payments. The lower initial interest rate of an ARM can result in significant savings compared to a fixed rate mortgage, especially if the initial fixed period aligns with the time horizon for owning your home. Some borrowers might qualify for a larger loan amount with an ARM due to the lower initial payment, which could be important for those in a high-cost housing market. Now, if you found this helpful, click the like button to let us know you enjoyed it. How can I prepare for potential rate increases with an ARM? Know the initial rate, the duration of your fixed rate period, the index to which your mortgage is tied, the margin, and the caps on how much your rate can increase, both at each adjustment and over the life of the loan. Calculate the maximum possible rate and what your monthly payment would be at that rate, and budget for this higher amount, even if your current payments are lower. Build an emergency fund to provide a financial cushion if your mortgage payments increase suddenly. Aim to save enough to cover several months' worth of living expenses, including the higher potential mortgage payments. And keep an eye on interest rates and refinancing options. If rates drop or your credit situation improves, refinancing into a fixed-rate mortgage or another arm with better terms might be beneficial. Stay informed about economic factors that influence interest rates. This can help you anticipate changes in your ARM's interest rate and prepare accordingly. Now, lenders are required to provide notices before the rate on an ARM adjusts. Review these notices carefully to understand how your payments will change. And if a higher payment becomes unsustainable, consider selling the property before the rate adjusts. You want a free report on your current home value? Click on the link in the comments. Now that we've seen both sides of the coin, let's talk about how to make the best decision for your situation. How do I decide between an ARM and a fixed-rate mortgage? If you plan to stay in your home for a long time, a fixed-rate mortgage is usually better because it offers stability and predictability over the long term. In a low-interest rate environment, fixed-rate mortgages are better because you can lock in a low rate for the life of the loan. If you are comfortable with the possibility of your interest rate and payment amount changing over time, and you can handle potential increases in payments, an ARM might be suitable. And if you expect your income to increase significantly, you might be more comfortable with the ARM, as you could potentially afford higher future payments. Now do yourself a favor. Hit the subscribe button and click the bell so you never miss an episode. What lessons can we learn from past housing market crashes related to ARMs? Many borrowers did not fully understand the terms and risk with their ARMs, especially the potential for significant increases in payments when rates adjusted upwards. Make sure you fully understand before you buy. Many people bought homes with ARMs intending to sell or refinance before their rates adjusted. However, when housing prices fell, they found themselves unable to sell or refinance, leading to defaults and foreclosures. Home values are not guaranteed to rise, and refinancing isn't always an option, especially in a down market. Remember, the right mortgage choice can make all the difference when buying a home, and remember to work with the right agent.